We don't always keep an asset the entire useful life. Sometimes we get rid of it. As an example, this is the depreciation schedule for our asset using the straight line method. And let's say that after year 3, we decide to sell it. So after year 3, we have $60,000 in accumulated depreciation and $50,000 in book value. Now, let's say that we sell it for $60,000. First thing we can probably look at is there cash involved in this transaction? And let's say that there is, that they're paying us $60,000 in cash. So let's debit cash $60,000. We are getting rid of the equipment, so we need to credit the equipment. Question is, though, how much do we actually credit the equipment? And one of the big mistakes is people think, oh, I'm going to put 50,000 here because that's what my schedule says it is worth. It says it's worth 50,000. So I'm going to credit the equipment 50,000. The problem with that is that the equipment account actually hasn't been touched since we first got it. We still have $110,000 sitting in the equipment account. So to successfully get rid of it, because we don't have it anymore, we have to credit the equipment $110,000 to offset the initial cost. So we need to credit the equipment $110,000. We also have to get rid of anything associated with the equipment, which includes the accumulated depreciation associated with that equipment. Right now, what we have in there, we put $20,000 in the accumulated depreciation each year. So each year we credited accumulated depreciation $20,000 for 3 years, and that means we have $60,000 sitting in the account. Let's debit the accumulated depreciation to get rid of it. So we will debit accumulated depreciation, $60,000. All right, so let's take a look at what we have in our journal entry right now. It doesn't balance. We have $120,000 in debits and only $110,000 in credits, which means we need another $10,000 in credits. This is a gain, meaning we, quote unquote, made money on selling this equipment. Our balance sheet said it was worth, again, quote unquote, worth $50,000, but someone paid us $60,000. So we made $10,000. And that is a gain on disposal. A gain is kind of like a revenue, but not really. Revenues have to do with what our business is, what we do every day. Do we sell stuff to customers? Do we provide services to our clients? And whenever we get money from our clients, that is revenue. Gains are when we sell something that for a price higher than what our balance sheet says it is worth. And our balance sheet in this case said it was worth $50,000, but we got $60,000 for it. Gains are, again, kind of like revenues that we made money, but it doesn't have to do with our main line of business. Gains and losses go at the bottom of a multi-step income statement. A multi-step income statement has at the top sales revenue and cost of goods sold to get the gross profit. Then we have all of the operating expenses, and below that we have the other section. Gains and losses go in the other section. All right, so we have cash, equipment, accumulated depreciation to get rid of that, and then whatever's left over is a gain or a loss. How do I know if it's a gain or a loss? Two ways. First of all, I can start putting together this journal entry, and if I end up needing a credit, it's a gain. Like revenues, we credit revenues, we credit gains. If it's a loss, in other words, we sold it for less than the book value. Let's say we sold it for $40,000 instead of $60,000. Then we would need a $10,000 debit. Losses are kind of like expenses in that we debit them and it shows that we lost value. And we have to debit those. So one way we can look at this is if we're trying to fill in the blank and we need a credit, it's a gain. If we need a debit, it's a loss. We can also compare what we received to the book value. In this case, we received $40,000, compare that to the $50,000 book value, and that is lower, so we lost value. If it is higher than the book value, then we gained value. All right, one more situation that I want to go for or cover here. Let's take a look at this. Erase all of this. Let's say we actually get to the very end of the asset. And we use it up the full 5 years, and now it's time to get rid of it. And initially we thought that we would get $10,000 for it. That was the salvage value. Turns out we actually didn't get anything. We had to throw it in the trash. It just went to the landfill. We got $0 for it. So we actually got rid of the asset, but there is no cash involved in this transaction. So no cash, but we got rid of the equipment. So we need to credit the equipment, the $110,000. Again, why 110? We haven't touched the equipment account since we got it. Nothing has gone in and out of the account. And so to get rid of the equipment, we just have to credit the full $110,000. We have to get rid of anything associated with it, which is the accumulated depreciation. At this point, the accumulated depreciation is $100,000. We added a couple more onto here, and so that got us to $100,000. So we need to get rid of that because that is associated with the equipment. And we have $10,000 left over. We need to debit $10,000 to make this journal entry balance. That would be a loss. So we threw it away. It still supposedly had $10,000 value, and we just threw it in the garbage. So we lost $10,000 worth of value by putting it in the garbage can. I know students often get confused about what do I do if I didn't get any cash. Usually it's a loss because you're just throwing it away, and if there's any value left, then you just lose that remaining value. The last situation that we can look at is what if we actually, let's say that we had zero salvage value. In our initial calculations, we had a cost of $110,000, salvage value of 0. And so let's just say this was 0. At the very end, what would our accumulated depreciation be? It would be equal to the cost, $110,000. So when we go ahead and throw that in the garbage, we would debit accumulated $110,000. That is the entire journal entry to get rid of an asset that is fully depreciated. We debit accumulated depreciation, credit equipment. It takes both of those pieces off the books, saying we don't have this equipment anymore. But there is no gain or loss. There's no cash. there's no gain or loss because we didn't actually gain or lose any value according to the balance sheet. The balance sheet said it was worth 0, so we just threw it away. And so in that case, that is the journal entry. It's as simple as that one to get rid of it. Some things I want to point out here. We have to, when we credit the equipment, whenever we get rid of equipment, we have to get rid of whatever is associated with it, which usually is the accumulated depreciation. So if we get rid of equipment, we also got rid of the associated accumulated depreciation. And ask yourself, is there any cash? And then compare the cash or that you got to the book value. If you got more cash than the book value, then it's a gain. If you got less cash than the book value, it's a loss. And again, the gains and losses aren't part of our normal business. So those go in the other section at the bottom of the income statement.